Hi everyone, Jai Hind, Jai Bharat, Jai Mata Di. Rajeeve Kaushik sir हमारे साथ हैं sir. Today's question is that we talk a lot about equity mutual funds. Are there any other kinds of mutual funds and should we invest in them?
I believe in one of our earlier videos we have talked about the classification. So a mutual fund as such is an industry, it is a mode of investment and a diversified and a very versatile mode of investment, and it can be classified in a lot of ways like a marine diesel engine or a diesel engine on board. So you can divide it mutual fund open-ended, closed-ended, mutual fund active and passive, and then of course mutual fund from the point of view of asset class. So like you have just said, equity mutual fund, in which we have been stressing that most of the people should have their holdings in equity, which is basically stock based. But another very important category for the purpose of asset allocation, which is not so attractive nowadays, so nobody talks about it, is the debt. Debt mutual fund is a complete category in which there are 6-7 types of different mutual funds. So first we have to understand what is debt mutual fund. As the name suggests, the mutual fund company takes the money from us, and in case of equity mutual fund they invest in stocks. But when they take the money from us and they invest in the debt market or they give loan. Now, whom can they give loan? They can give loan either to the government or they can give loan to the private companies. Then there can be other things also, that they can buy some debt papers or the of these public sector companies, power companies. They can make some FDs at a very higher rates which you may not get as an individual, but these people of mutual fund companies will get. So all this combined category comes as debt funds. And further, there is a different classification of it depending upon what is the duration of the debt paper that they are purchasing. What is debt paper? When I am giving money to you, then you have to give me a receipt that you have taken so much money for so many years at so much rate of interest, which is called coupon rate, that you will give me so much of returns. So naturally, for a company which is not so well known, the rate of interest will be high because the risk is high. For a company which is well known, the rate of interest will be low because the risk is low. This will be applicable for private companies. And in this, if the duration of maturity of the paper is quite huge, more than 3 years, 4 years, or even 10 years, then it is called long duration. Similarly, it becomes medium duration, low duration, ultra low duration, and then there can be mutual fund, debt mutual fund, which invest only in government securities. They are called gilt funds. They only invest in the government papers. So naturally, because they have the government backing, they are considered to be most safe. There was a certain case 2 years ago, 2.5 years ago, when one of the mutual funds of one mutual fund company called Franklin Templeton ran into some bad name. Even though in time that company paid off all the investors, but that bad name was generated. So all these mutual funds, all this debt category can be invested by all of us. And earlier, especially, there is a category called liquid fund. Liquid fund also means that they invest in papers which are about 1 week to 2 months duration. Means they will mature within this time. So till about 1 year ago, I myself used to do it, and I used to advise all of you to put your money lump sum in this liquid fund. And from there, the money used to go by way of STP into the equity funds. So these debt funds were considered to be like reservoirs, or like the expansion tank that we have in the engine room when you enter the engine room. Those who of you have not seen the ship, you will see it. So we create a reservoir where the money is there, and from there it goes into the equity fund. But this strategy now we have given up for some reason, because in this the taxation was becoming an important factor, and also the timing was not so good. But all the same, right now debt funds are not really of great value to the seafarer, simply because that the return is not matching the NRE fixed deposits. NRE fixed deposit, because of the tax-free status and 5.5% returns, actually comes up much better than most of the debt funds for the time being. Debt funds also have a very curious characteristic. It's very important to know that when the rate of interest in the bank goes up, that time the return from debt fund falls. So right now we are in a time when the rate of interest in the banks are going up. So the yield, the returns, not the yield, the returns from debt funds will substantially be going lower and lower in the long duration funds, like we have said. Debt funds are actually more complicated and can actually become little more risky than an equity fund, because if you have invested in a class which has invested in a company or given debt to a company which is likely to go down, then the capital is at risk. The entire capital may be at risk. So that is why we must invest in debt funds, but with some knowledge or with some advice of a professional, because it can actually backfire. Right now, as a earning seafarer who's earning a tax-free income, you are better off keeping it in the NRE fixed deposits. And even if you wish to, some people who are in the higher earning group, who have already made their portfolio corpus, achieved their financial independence, which I mean to say they have already accumulated 5 crores in excess, or even a little less than that, they can select funds like dynamic bond funds, which automatically shift the money from place to place depending upon the market condition. So they can keep it. But it is also important to note that the taxation of debt funds is different from equity funds, where equity funds are taxed after 1 year at a rate of 10%, and a deduction of 1 lakh is given in the capital gains. That means if you have invested 10 lakhs and you have got a return of 3 lakhs, then out of that 1 lakh is offset, and out of 2 lakhs you have to pay 10%, that is 20,000 as tax. Whereas for debt funds, this thing happens after 3 years. If you sell before 3 years, then the entire capital gains of the debt fund will be added to your taxable income from Indian sources, and you will be subjected to tax on that. After 3 years, you will have to pay either 10% without indexation, or if you want to take advantage of the indexation. What is indexation? We will make a separate video on this to explain. But right now it is sufficient to say that with indexation, if you take, you have to pay 20% tax, otherwise 10% tax. So that is a summary of debt funds. And it is definitely a avenue, because when you talk about asset allocation, your 10, 15, 20, 25% or even 30% should be in debt class. Now, debt class includes debt funds, but it also includes things like NRE FDs. It also includes things like PPF in your spouse name, in your children's name. Debt funds, debt can also include the category of your other deposits that you may make in India, or even FCNR that you keep in dollars if you like to keep. It's a good choice. So that is all about debt funds.
So, sir, thanks for the knowledge, sir, and we really appreciate your views. So, guys, again, last but not the least, we are just the advisors. We मतलब sorry, just the advisor. अपनी अकल लगानी है आपको. Become learned. यहाँ से सीखिए और जाके चीज़ें सीखिए, किताबें पढ़िए, so that you don't make mistakes. And if we make mistakes, learn from them. That's the best part. Thank you very much. जय हिंद, जय भारत, जय माता.